what do you think is the most common avenue that people need funding for small and medium sized business? So I want to like stay away from companies issuing bonds, right? Like in securitization of debt that way. So stay out of investment banking world, just those small to medium sized business, which I think is like, can we define that to maybe what is to a banker? And this is probably a better place to start. To a banker, what's a small business and what's a medium sized business?
It has to do with revenue and how much revenue you have. So a small business, you're probably doing $200,000 or less per year in revenue type thing.
Okay.
If I'm just putting a really broad stroke on it.
Yeah.
Medium-sized business, you're at least generating $200,000 a year plus up to maybe $5 million and then maybe $5 million and up of revenue generated per year. You're kind of in the larger size business.
Okay. And at what point, in my world, those are all micro businesses, right? So like these are the skills within, let's call them
I'm
micros,
sticking
right?
to St. George.
Yeah, right.
Yeah.
So I'm just always thinking, okay, you're dealing with, when I'm looking at the broad market and securities, you're talking about, trillion and billion dollar companies, and right. And so you talk about companies that are a couple $100 million, and that's like your micro caps and your small cap stocks, right? So we're talking about like your local businesses that names you recognize in your community, but they're not publicly traded, large employers per se. So you have like your smaller, so within this kind of small category, you have 200,000, under 200,000, 200,000 to, you said, a couple million, 5 million. Okay. And then you have 5 million up to like, what's the upper bound where you just go, you're probably looking for something like way more in depth than your average local or like regional bank is going to be able to kind of handle or take on. Is that like 100 million in revenue?
Yeah.
Okay.
Probably be above 100 million. You're definitely in that larger market type scenario, which in St. George, I mean, we only have a handful of companies that do more than that.
Yeah. Yeah. You're starting to get like that's in the global picture, that's still small business. Mm-hmm. But in the macro or regional picture, that's big business, right? So there's always this disconnect, right? Between like, well, I have a medium-sized business. Like, well, what does that mean? Right?
Yeah.
And within what category, right?
Yes.
And not to ever discredit anyone, but I just want to make sure that we're defining out like, who are we talking to about this today? And how can we help those people or not, or, get them the information they're needing. So would you say like most people are probably, it sounds like are going to fit in that medium-sized business, right?
Yeah.
Especially when they need funding. If you have less than 200,000 in revenue, you probably you either don't need or can't qualify for a lot of funding. Aside from just personally guaranteeing some kind of more on your own personal credit and assets, right?
Yeah. So let's just start talking about commercial banking kind of from the top type thing.
Cool.
So starting from the top, in the residential mortgage world, you have debt to income.
Okay.
In the commercial lending world, it's called debt service coverage. And it's just the inverse of those things. Rather than debt to income, it's income to debt. Mm-hmm. And so we're looking for, ideally, we like to see it at a 1.25 or higher. Now, if I said that a debt to income, that's like a 75% debt to income.
Yep.
So businesses can be more highly leveraged than a like residential household can be. And that's because on that income, you can expense all that out on a business. And then, okay, what do I have left on some of this stuff? So we're always looking for like a 1.2, 1.25 or greater debt service coverage ratio. So making sure we're generating enough income to cover the debts that the business has. Okay. So that's kind of when people say, debt service coverage ratio or DSCR, they're just talking about, do we have enough income to cover our debts?
And is that revenue covering debts or net income?
Net income covering. Yep.
Covering debts.
Yep.
And the net income on an annual basis. So if you're wanting a 1.25, what you're saying is if you take $100,000 loan out, you're looking for somebody to have a net income of $125,000, right? Now the payments.
The payments of $100,000 per year.
Gotcha.
You need to have $125,000 of revenue to cover that.
You want to cover the obligation to make the payments on time.
Yes.
Okay.
Yep.
So if you had $100,000 loan and after you look at the amortization schedule, let's say it comes out to $25,000 a year in payments, you're looking for somebody to, in order to get that $100,000 loan, they have to have a net income of what is that? $37,500.
Yes. So it's done all off of cash
that's
flow.
1.5, but okay.
It's done off of the cash flow. So depending on your amortization, long, short, however much you're borrowing, it comes down to that payment. And then, yes, how much income do we have to cover that payment?
Okay.
So that's the very nuts and bolts of the cash flow side.
Yep.
I've always considered commercial lending to have two sides. You have the cash flow side and you have a collateral side.
Okay.
So with the collateral side, we're saying, hey, what's the value of this? What kind of leverage, is it our policy to be 75% on equipment, or what does that look like? And so the collateral determines how long of a loan I can do. So if it's equipment, then I'm looking at a 5 to 7 year time amortization. Land is typically 15 to 20 year amortization, and commercial real estate, you're typically at a 20 to 25 year amortization. It doesn't follow the mortgage world. It's not a true 30-year amortization. Also with that, the mortgage world gives you, a 30-year fixed rate. Typical commercial lending is not that. Right now with interest rates, you're seeing like a 3-year or a 5-year adjustable rate, meaning it's fixed for those 3 or 5 years, and then it readjusts to market rate, and then it goes for another 3 to 5 years, and it will readjust to market rate. And so the rates are on a much different structure than what like residential mortgage lending is too. So that's worth noting.
Yes, that is, and I could talk for an hour about that and the securitization side of bonds, but no one wants to listen to that. So we'll move on. Okay. So you have, I'm trying to buy stuff for my business. I'm trying to buy basically property, plant, and equipment.
Okay.
Right?
Yep.
I'm trying to buy, like, if I'm a construction company trying to buy another excavator.
Yep.
Or I need to buy a warehouse, right? Or a manufacturing facility, or I have a retail business and I want to buy a storefront, right? Or even, and this one's probably harder to pull off for a lot of people, but I have like myself, like if I wanted to buy an office to run my wealth management business out of, and I wanted to own the building instead of being a renter, right? I felt for whatever reason that was a strategically good move for my business long term. Then you can get these commercial loans.
Yep.
For that. And that has its own set of rules, you're saying, for like loan to value on the asset and the viability and collateralization of that. So that becomes a collateralized debt, right?
Yep. And most of what banks do, like 98%, is collateralized. So there's usually always collateral. So let's talk about some of the different classes that you can do within that. Because if you're going out and buying an office space for yourself, then that's owner occupied. So owner occupied always has a smaller percent down than if you're doing like a true investment property. So if you're looking at bank financing and you're looking at buying an office, then that's typically 20% down for regular bank financing. If it's an investment property and you want to go buy it to rent it out to somebody else, you're looking at 75 to 70% financing. So 30 to 25% down on that type of an investment.
And you said how much on owner occupied? Owner
occupied is typically a 20% down. Now, there is another option. It's called the SBA 504 program, and that program typically allows as little as 10% down. So if you are an existing business and it's not a specialty project and you're just growing and buying your own real estate, you could do that with 10% down. If you are a startup company, you can tick on 5%, or if it's a specialty type property, you can tick on another 5%. So that one would go up to 20%, even with the SBA 504. But for most companies, you're an existing company, you're growing, you just need an office, a warehouse, an industrial type building, and those you can commonly do with 10% down.
Now, office buildings, especially like around here, it's usually I'm thinking of a 2 or 3 story building, and let's say there's a couple offices, like a couple suites on each floor. What are the rules around what am I occupying, right? Like, do I just have to occupy one of the suites in that building, or do I have to occupy the whole building? What makes something like owner occupied versus investment? Where's that line kind of drawn? In the residential world, people recently just got in trouble because they were kind of fudging the numbers on that a little bit, right? And originating loans that weren't truly, owner occupied, and they were kind of really more investments. So I always tell people, stay between the ditches, So like where's that line drawn? I imagine there's a line.
Typically, it's at 50%.
Okay.
Like if you're going for straight bank money, that's typically at 50%. And
Okay.
so if you are occupying 50% and you're renting out 50% of the property, that's about where that line is. With SBA, if you're buying an existing building, then, I got to go back. It's like 50 or 60% owner occupied. But if you're doing it on a construction, you have to grow into 80% of that building over a 3-year period.